Market manipulation occurs on a daily basis, right under the noses of retail traders. You witness this yourself, every day, and you're wondering why the theory of support and resistance you read in almost every trading book doesn't seem to work in real markets. Today I'm sharing my experience with support and resistance trading, but in the context of smart money, and you'll learn the best practices to trade and avoid being manipulated by big market players. You know the drill. Like, subscribe, and stick around for the full video. True or false? The more times a level is tested, the more valid it is. If you said true, you are wrong. This statement is one of the biggest lies in trading. In my experience, really strong support and resistance levels immediately push price away from them. There is enough buying pressure at support, enough buyers waiting to buy at the level, that the market is immediately moved up and away from the level. If price can hang around the level or quickly comes back to the level, it suggests a certain lack of conviction on the part of the bulls. If the market is able to retest the level many times, then you have a potential setup for a breakout through the level. In this example, the orders at the support level are absorbed each time price revisits the area, until buyers lose their power. Price then plunges through the zone with little difficulty. Also, look at this resistance level. The upper zone was tested several times, and sellers came in pushing the price down. This resistance level was gradually eroded as more and more sellers had their orders filled. Eventually, there were less sellers and price broke through. Personally, I avoid buying a support which has been tested multiple times in the past. The greater the number of times a zone is tested, the more likely it is to break. When a support area is tested multiple times, some or all of the waiting buy orders are executed, leaving less willing buyers at that level. Once all buyers have gone, price can move through that level to the next area. From my experience, the best entry is the one where price drops to support and quickly moves up, leaving a long shadow on the candle that dropped through support, the liquidity clearout. I would much rather buy a broken support after a liquidity clearout than a clean support. That trade is 10 times better to me than buying a clean, exact support level. At one point, price leaves a support or resistance level and starts trending. A strong imbalance between buyers and sellers leads to strong and explosive price movements. As a rule of thumb, remember that the stronger the movement away from a level, the more interest will usually still exist, especially when the time spent at the level was relatively short. So when price goes from selling off to a strong bullish trend, there had to be a significant amount of buy interest entering the market, absorbing all sell orders, and then driving price higher. So the next time price revisits the area, I would be very interested to buy that support. Always look for extremely strong turning points. These are often high probability price levels. Price manipulation is a series of actions carried out by smart money to induce either buying or selling activity from other traders. Why would they do that? because smart money uses position sizes that stop them from simply hitting buy or sell as you and I would do. Because their position sizes are so massive, they must enter over a period of time so as to not spike the price and reveal the position they're entering. Because of this, they have to seek out areas in the market where there is enough liquidity. That's why a great deal of orders reside around support and resistance zones. Take a look at this example. This shows a very common pattern in the market, the key differences of where the professional money enters and where the retail trader enters. The retail trader buys and takes a long trade when price breaks a previous resistance level and price is at a new high. Admit it, it's a strategy you use often. But soon after the entry, price moves lower from the previous high, and you often get stopped out. At the same time you are stopped out, the professional traders are entering the market. That's the difference between retail and smart money. Retail traders buy at support, but smart money buy below support. And when price moves higher, the professional traders will cover their long trades and start taking their profit. At that time, the retail traders are just starting to enter long. When you enter from these areas that are at extreme highs or lows, the big players are taking profit. And obviously, entering the market when the smart money are getting out is not a smart plan. A common saying in trading is, buy any weakness and sell any strength. So if price moves lower from an extreme high, then you can look to buy from a value area. And if price moves higher from an extreme low, then price can be sold from a value area. Here's price moving from an extreme high back lower. This is price showing weakness and moving to a value area for a possible buy entry. If you have entered a long trade from this high, you would have been stopped out. But if you have instead entered a long trade when price showed weakness and moved back lower, you would have entered at a much better area. Price spends most of its time in consolidation. This is the market showing you a balance in price. There are several reasons for the price to consolidate. One of them is liquidity generation. When price consolidates for an extended period of time, the masses start to place support and resistance levels at the extremes of the consolidation zone. Any sudden break out of this consolidation range will tempt traders to enter. These entry opportunities are traps set by the market makers using this consolidation technique. If you are using certain indicators, things are even worse. When the market is in consolidation, moving averages, probably the most common indicator, will get very close together. The most common entry signal is given to retail traders when two moving averages cross. A breakout outside the consolidation plus the crossover indicate to retail traders that the trend has now changed. This is a false signal that the price will increase. All of these confirmations are seducing the average retail trader to take a buy position in order for the smart money to fill their massive sell positions. And by the time the indicators signal the change to a downtrend, The market has already made most of its move. The point is, smart money knows that even the smallest break outside of a consolidation area will set off the signal to masses. This is a well-known tactic used by market makers to trick retail traders into buying or selling certain levels. Liquidity is just a fancy word for you taking a position. The more people taking positions, the more liquidity you have. The big players need lots of liquidity in order to fill their massive orders. So how do you think they get this liquidity? By creating well-known retail chart patterns in order to involve the retail traders into the market. These patterns are used by smart money to induce you to take a position. You might have a small account and trade with many lots, but remember, millions of beginner traders are in your shoes and use the same information to trade. Trading will always be a game between smart money and the dumb money. How many times have you traded a triangle pattern, for example, just for the price to do the exact opposite as soon as you jump into your position? Retail traders might see these patterns as continuation patterns, but the smart money are seeing them as reversal patterns. You have to start putting yourself in the shoes of the large institutions and big money players. Think like the hunter, not the prey. Always remember that smart money are always searching for pockets of liquidity in order to fill their desired positions in the market. They are always looking to shake out weak hands, particularly around support and resistance levels that are being widely watched. It's time to reconsider how you see support and resistance levels, and to start building a strategy that allows you to join the smart money after a liquidity clearout. Most of the traders who trade support and resistance try to predict where a movement will end, instead of trading in the direction of the movement itself. What these traders typically tend to do is mark all the levels which the market hasn't encountered yet and wait for the price to enter the zones before going either long or short. But there are lots of levels forming in the direction of the current movement, which the trader is neglecting to trade, because he is so focused on predicting where the price will reverse. My advice is to start taking trades at levels which formed in the direction of the most recent high or low. A new high or low is a signal that the current momentum is to the upside or downside. So by trading against this momentum, you are unnecessarily putting yourself at risk of losing money because you're trying to trade against the trend. I said it quite a few times before. One of the best places you can find high probability support and resistance levels is around the big round number levels. The support and resistance levels you can find situated around these prices have a high probability of causing a large reversal to occur. Just open any chart and you'll see that many big reversals will begin once the price has either almost hit a big round number or has just moved beyond it. If you found value and learned something new, leave us a like. This way we'll know if you'd like to see more videos like this one. And check out our Academy program if you want to further level up your trading. Until next time.